There was a time when Enron was not just a successful company. It was a symbol of intelligence, innovation, and the future of American business. Wall Street loved it. Journalists praised it. Politicians respected it. Investors trusted it. Employees believed they were working for one of the most brilliant companies in the country. Enron looked unstoppable, a modern giant that had somehow figured out how to turn energy into endless profit. But behind that polished image was a machine built on manipulation, pressure, fake profits, hidden debt, and one of the biggest corporate lies in modern history. The company that once looked like the smartest business in America was, in reality, hiding a truth so dangerous that when it finally came out, Enron collapsed in a matter of weeks. Billions of dollars disappeared. Employees lost their savings. Investors were wiped out. And one of the most powerful companies in the United States became a warning sign for the entire corporate world. If you had looked at Enron in the late 1990s, you probably would have thought it was exactly the kind of company the future belonged to. It wasn't just another old energy company. It had transformed itself into something much more exciting. Enron talked about innovation, markets, technology, and complex financial strategy. It didn't want to be seen as a boring pipeline business. It wanted to be seen as a new kind of company, one that could dominate the future of energy trading and reshape how the market worked. That image was incredibly powerful. In a time when investors were hungry for fast growth and big ideas, Enron offered both. It sold the dream of a company that was smarter, faster, and more advanced than everyone else. And for a while, the world believed it. To understand how Enron pulled this off, we need to go back to where it started. Enron was created in 1985 through a merger between Houston Natural Gas and Internorth. Kenneth Lay became the face of the company. He was polished, connected, and extremely good at selling a vision. But Enron's real transformation began when Jeffrey Skilling entered the picture. Skilling was intelligent, aggressive, and obsessed with the idea that Enron could become far more than a traditional energy business. He believed deregulation in the energy market created a massive opportunity. Instead of simply owning pipelines and selling gas in the old-fashioned way, Enron could act like a trader, a middleman, and a financial powerhouse all at once. It could buy, sell, structure, and profit from energy contracts in ways that looked modern, brilliant, and highly scalable. That idea changed everything. Under Skilling's influence, Enron stopped thinking like a normal utility company and started thinking like a Wall Street machine. It expanded into energy trading, then into broader financial deals, and eventually into businesses so complex that even experienced analysts struggled to explain exactly how Enron made its money. But complexity can be very useful when you don't want people asking too many questions. The more complicated Enron became, the easier it was to hide what was really happening underneath. Enron's leadership became one of its biggest selling points. Kenneth Lay was the calm public face, respected, politically connected, and trusted by powerful people. Jeffrey Skilling was the bold strategist, the man who made Enron look like a company full of genius. Then there was Andrew Fastow, the chief financial officer, who would become one of the central figures in the scandal. Together, they helped create a company culture built around growth, performance, and image. But it was also a culture built around pressure. At Enron, success was everything. Numbers had to look strong. The stock price had to keep rising. The market had to stay impressed. Failure was unacceptable, and weakness was dangerous. In that kind of environment, the temptation to manipulate reality becomes much stronger. And that is exactly where Enron's fraud began to take shape. One of the most important tools in Enron's deception was something called mark-to-market accounting. Now, on its own, mark-to-market accounting is not automatically fraudulent. In simple terms, it allows a company to estimate the current value of future profits from a deal and record those estimated profits today. The problem is obvious. Estimates can be manipulated. If you are honest and conservative, this system might be manageable. But if you are desperate to make your numbers look better than they really are, it becomes incredibly dangerous. Enron used this system in a way that made the company look far more profitable than it actually was. Imagine signing a long-term energy contract that might make money over the next 10 years. Instead of waiting to see what the real profit would be, Enron could estimate how much money it expected to make in the future and book a large portion of that profit immediately. On paper, that made Enron look successful right now. But in reality, the cash had not arrived, the risks were still there, and the future was uncertain. If the deal later performed badly, Enron would have a problem. It had already recognized the profit. So instead of admitting the truth, it often found ways to hide the losses and keep the illusion alive. This is where Enron's accounting tricks became far more dangerous. Andrew Fastow and others built a network of off-balance sheet entities, often called special purpose entities or SPEs. These structures were designed to keep debt and losses away from Enron's main financial statements. To outsiders, Enron looked healthier than it really was. But behind the scenes, the company was using these vehicles to hide liabilities, move failing assets out of sight, and create the appearance of stability. In plain English, Enron was cleaning up the front window while dumping the mess in the back room. This mattered because investors, analysts, employees, and even board members were relying on Enron's financial reports to understand the business. If those reports were distorted, then almost every decision based on them was also distorted. Investors kept buying, employees kept believing, the stock kept climbing, and Enron's leaders kept getting richer as the company's market value rose. That created a dangerous cycle. The more the stock price mattered, the more pressure there was to protect it. And the more pressure there was to protect it, the stronger the incentive became to hide bad news, invent confidence, and keep the machine running. For a while, the machine worked. Enron was celebrated as one of America's most innovative companies. It was praised again and again. The media loved the story. Analysts admired the ambition. Enron presented itself as a company that understood the future before anyone else did. But there was a major problem. The company's financial statements were becoming harder and harder to understand. Even smart people had trouble figuring out where the profits were really coming from. And when a company becomes too complicated to explain clearly, that alone should be a warning sign. Some people did start to feel uneasy. Journalists and skeptics began asking questions. One of the most famous early warning signs came when Bethany McLean of Fortune asked a very simple question. How exactly does Enron make its money? That question mattered because if a giant public company cannot clearly explain how it earns its profits, something is very wrong. Enron's image was strong, but the foundation under that image was becoming unstable. Inside the company, there were also people who knew the situation was dangerous. One of the most important figures in Enron's collapse was Sharon Watkins, a vice president who became deeply concerned about the accounting practices being used. She warned Kenneth Lay that the company could collapse in a wave of accounting scandals. That warning was a massive red flag. It meant the danger was not just outside criticism anymore. It was now coming from inside the company itself. But by then, the machine had been running for too long, and the truth was too expensive to reveal. As pressure increased, cracks started to spread. In 2001, Jeffrey Skilling suddenly resigned as CEO after only a short time in the role. Officially, the explanation sounded personal and vague. But to the market, the resignation was alarming. This was one of the men most closely associated with Enron's success. If he was leaving so suddenly, investors had every reason to be nervous. Kenneth Lay tried to calm everyone down. He reassured the public. He insisted the company remained strong. But trust had already started to leak. Then came the financial revelations that changed everything. In October 2001, Enron announced a major quarterly loss and disclosed a huge reduction in shareholder equity tied to its off-balance sheet partnerships. Soon after, the company admitted it would have to restate earnings from previous years to correct accounting problems. That was devastating. Restating earnings is not a small issue. It tells the market that the numbers people relied on were wrong. It tells investors that the picture they believed in may have been false all along. Once that happened, confidence collapsed quickly. Creditors got nervous. Analysts pushed harder. Regulators started paying attention. The Securities and Exchange Commission opened an investigation. Andrew Fastow was removed. Enron stock began to fall hard. And when a company built on confidence starts losing confidence, the fall can become brutally fast. Investors who once saw Enron as a genius company now saw a giant question mark. The same complexity that had helped Enron hide its problems now made those problems look even scarier. One of the most devastating parts of the story is what happened to Enron's employees. Many of them had been encouraged to believe in the company so strongly that they held large amounts of Enron stock in their retirement accounts. They weren't just working for Enron. Their future was tied to it. Their savings, their security, their plans, all connected to the company's success. While top executives had sold large amounts of stock and protected themselves, many employees were left exposed. As Enron's share price collapsed, their retirement savings were destroyed. People who had spent years building their careers suddenly watched their financial future disappear. That is one of the ugliest parts of corporate fraud. The people who pay the price are often not the people who created the lie. And the lie was enormous. By late 2001, Enron was running out of options. A rescue deal with Dynegy briefly appeared possible, but it fell apart. Credit ratings were cut. The stock collapsed even further. On December 2, 2001, Enron filed for Chapter 11 bankruptcy protection. At the time, it was the largest corporate bankruptcy in American history. A company once worth tens of billions of dollars had imploded. The business world was stunned. This was not some small, unknown fraud. This was Enron, one of the most admired companies in America. But the collapse of Enron did not stop with Enron. Its accounting firm, Arthur Andersen, was pulled into the scandal because it had audited Enron's books while also maintaining a relationship that raised serious questions about independence and oversight. Andersen was accused of destroying documents related to the Enron audit, and the scandal ultimately destroyed the firm's reputation. Arthur Andersen had once been one of the most powerful accounting firms in the world. Enron didn't just take down a company. It helped take down one of the biggest names in corporate auditing. As investigators dug deeper, the full picture became even uglier. The fraud was not one single trick. It was a system. It involved misleading accounting, hidden debt, deceptive partnerships, executive conflicts of interest, and a culture obsessed with appearances. Enron had created an environment where numbers were used not to reveal reality, but to control perception. It wasn't just about making the company look better. It was about protecting the stock price, preserving executive power, and delaying the moment when the truth would become impossible to hide. Eventually, legal consequences followed. Jeffrey Skilling and Andrew Fastow became central figures in the criminal cases. Kenneth Lay was also convicted, though he died before sentencing. Enron became a national symbol of corporate greed and accounting fraud. It also helped push major reforms in the corporate world, including the Sarbanes-Oxley Act, which aimed to strengthen financial reporting, executive accountability, and auditing standards. In other words, Enron became so destructive that the system itself had to change in response. But if you strip away all the legal language, accounting terms, and corporate complexity, the Enron story becomes much simpler. It is the story of what happens when a company becomes more committed to protecting its image than telling the truth. It is the story of executives who believe they were too smart to be caught. It is the story of a market that rewarded complexity without demanding clarity. And it is the story of ordinary people who trusted a giant company and paid the price when that trust was betrayed. What made Enron so dangerous was not just the fraud itself. It was the fact that the fraud wore the costume of brilliance. Enron did not look like a failing company. It looked like the future. That is what made it so persuasive. That is what made it so deadly. The company convinced the world that complexity was proof of genius, that rising stock prices were proof of strength, and that confidence was proof of truth. But confidence is not truth. Hype is not profit, and a complicated business model is not the same thing as a healthy business. In the end, Enron became one of the clearest examples of how corporate power can be used to hide reality instead of build value. It showed how dangerous it can be when executives, accountants, auditors, and investors all become trapped inside the same illusion. It showed how greed can spread through an organization until even basic honesty starts to feel like a threat. And most importantly, it showed that when a company spends too much energy protecting the story, it eventually loses control of the truth. Enron did not collapse because one quarter went badly. It did not collapse because the market was unfair. It collapsed because the company had spent years building a business image that reality could no longer support. Once the illusion cracked, everything fell apart. The stock, the trust, the careers, the savings, and the reputation of one of the most admired companies in America. And that is why Enron still matters today. Because the names change, the industries change, the technology changes, but the pattern does not. Big promises, complex numbers, untouchable executives, a story that sounds too perfect, and behind it all, a truth that gets harder and harder to hide. Enron was not just a scandal from the past. It was a blueprint for understanding how corporate fraud works when intelligence, ambition, and greed all point in the same direction. So the next time a company looks too brilliant, too unstoppable, too complicated, or too admired to question, remember Enron. Because sometimes the smartest company in the room is just the one telling the biggest lie.